So today's session is on cash flow statements. So it will probably last 40 to 45 minutes. This one's a little bit shorter, but it depends. If we get a few questions from the crowd, we can potentially go for the full hour. So what I'll do is I will share, I'll put this into presentation mode for the time being, and yeah, I guess we'll make a start. So in terms of cash flow statement, I guess most of you are aware of what the cash flow statement is. It forms part of the financial report for the majority of companies in Australia. Quite unique in Australia that you do kind of still do that direct method cash flow. If you go over into Europe or Asia, you tend to see the indirect cash flow more widely used, but we do seem to persevere with the direct method here, which I think to a certain extent is kind of more robust in a way. But we do obviously also have the cash flow rec note, which we'll get into later. So in terms of kind of who's required to prepare cash flow statements, it is most companies that have to lodge, well, all companies have to lodge reports of ASIC basically. So our listed public entities, unlisted public entities, large proprietary companies, and potentially other ones such as funds and other small proprietary companies. I think the cash flow statement does offer a lot of benefits to an organization. I mean, some people, rather than looking straight at the P&L and balance sheet, they'll actually go straight to the cash flow statement. So, that's something to bear in mind as well when you are preparing this. It does have quite a significant impact on how people view your business. Obviously, that cash flow from operations number is very important, and it kind of, justifies, almost the purpose of the business in that, are you kind of profitable and are you kind of, generating cash that's going to lead the business to continue. So it is kind of widely looked at. I guess it's kind of split into three main areas, but I guess our uses of a cash flow statement, as I was saying, to understand business performance and cash management strategies, and also compliance. So obviously we have to do the cash flow based on the requirements of ASIC, ASX, etc. Internally, whilst we do have the kind of statutory cash flow that we present, a lot of people, obviously do a lot more detailed cash flow budgeting, especially in the, the small cap, micro cap space that I spend a lot of time working in. So it does form a very important part of the kind of financial reporting process, in that, at certain times when we're in kind of the small micro cap space and we are kind of in that development growth phase, we will need to kind of map out when we may need to go to the market and try to raise additional capital from a going concern perspective, and also whether we need to talk to a financial institution such as a bank in order to keep the business moving and kind of bring on things as we need them. So the structure of the cash flow statement, I think most of you are probably aware of this. So the cash flow from operating activities, so that's our day-to-day, business activities, revenue generated, payments out for salaries, suppliers, such like. So that's kind of, our day-to-day, and that's what people really look at. It doesn't include kind of one-off items such as, your business combinations or your capital raises or, other kind of payments for fixed assets or plant and equipment and such like. So then we do come into the investing activities, and this is where a business might make an investment in something such as capex, either through plant and equipment, land and buildings, or intangible assets such as capitalized development if you're in kind of the technology or medical technology space. In terms of the cash flow from financing activities, one of the kind of stuff here is predominantly kind of bank loans or cash raisings from kind of equity raises. So one of the points to note here in the financing one, and you will see this as we go through some of the examples, is that any kind of transaction costs that you kind of incur would offset the financing activities rather than go in operations. So I think we're kind of all aware of that from kind of how we do things. Non-cash activities, obviously these are, we'll get into the more example of these, but there can be things, like share-based payments where, for example, you issue share-based payments to employees or directors, but there's not actually any physical cash transferred. Likewise, things like AASB 16 lease adjustments or depreciation, amortization, they're kind of some of the key non-cash items, but we'll get into how to treat them as we go through the session. So I kind of really just touched on this already. So activities, receipts of sale of goods and services, interest payments, income tax payments, and payments to suppliers of goods and services, etc. So salary and wages paid to employees, and any other real type of operating admin expense, marketing, that kind of thing would be included in your operating cash flows. Just as a side note here, the key standard is AASB 107 is quite an old standard. That's kind of our guideline here. So there are a couple of intricacies between operating and financing, depending on the nature of your industry. If you are kind of, say, for example, a financial services organization, you might put things, in operating activities where another organization might classify that as financing. So there is an element of judgment when we kind of categorize these items, but the key is obviously to be consistent year on year and have your key accounting policies written out in your financial statements as required. If there is some kind of key estimation and judgment in terms of the classification, then you might choose to disclose that in the critical estimates and judgments note. In terms of the investing activities, so obviously purchase of plant and equipment, purchase of intangible assets, so normally things like brand names, patents, such like, and then an acquisition of business. And one of the examples I've got for you guys today is in relation to acquisition of a business and how we kind of treat that from a cash flow perspective, because it is a little bit unique. Effectively, when you look at your cash flow from investing activities, when you do kind of view that, what the cash outflow or such like would effectively be what you've paid physically for the business, and that kind of has a big impact through the rest of the cash flow statement as you go through. So it's just something to bear in mind there. The other kind of item here that I probably haven't mentioned, in this session, is term deposits or other financial assets. So we might choose to buy equity instruments in another organization. We might take up a shareholding in an unlisted investment. We might purchase a term deposit, although it's probably not the greatest use of funds at the moment, given where the interest rates are. But there's still people out there that do kind of feel the value in term deposits, and that obviously gets treated as an investing activity, because on the face of your balance sheet, the term deposit is treated as a financial asset if it kind of matures more than 90 days after the year end. If we do have these long-term deposits that we're continuing to roll, they really should be treated as financial assets, and movements in those should go through investing activities as opposed to sitting in the cash balance. So just something to bear in mind there. Proceeds from the sale of assets as well. So you might get a cash inflow here if you sell a particular piece of land or such like. So there's a number of things there that will be included in investing, just to bear in mind as you kind of go through preparing the statement. In terms of financing, repayment and drawdowns of loans and borrowings. So the interesting thing about this, and one of the common things that we often see, is that people try to net repayments and drawdowns. You just need to be careful of that in terms of how we do it. So quite often you really need to show them gross, so the total amount you've drawn down in the year offset by the total amount you've repaid, rather than showing the net figure. So that is something that we have seen kind of come through as we've reviewed cash flow statements, and it can be a little bit more onerous, obviously, in working out how much we've physically drawn down and how much we've ended up repaying. So just something to bear in mind when you're doing that, as just a little bit of a tip. Having said that, if you do have one particular loan, then you might choose to net it, but I'll just speak to your advisor about their thoughts on the matter. One of the key ones is really related party loans and borrowings, and you don't tend to see this so much in the listed space, but in kind of the large proprietary space, you might have a group structure where there might be related party loans, either from the key shareholders or other entities further up the group. So it's just important to make sure that you net those off, and you show them growth rather. And also, given the changes in the end of special purpose, which I'll do a session on potentially next year, these kind of related party transactions, key management personnel and stuff, that's all going to need to be disclosed if you haven't early adopted this year. So that's something to bear in mind as you kind of go through this financial year. Issuer shares net of costs. I think I've already kind of discussed that. So when I talk about net of costs, I'm talking about things that are directly attributable to the issuer shares. So that's legal fees, investigating accountant fees, brokerage, even kind of the printing costs if you had to print hard copy prospectus and such like. And I know these costs sound pretty trivial, but some of them anyway. I mean, when you issue shares, the key cost is going to be your brokerage and then your legal. They're going to be the two big ticket items as a minimum, but just do remember that you can kind of offset them to equity, and you don't take them through the P&L, and then from a cash flow perspective, they're included in financing. So just bear that in mind as you go through. Dividends paid go through as financing. So that's obviously, if you are in a position where you're paying dividends, go through there. And then lease payments and AASB 16. And this is an interesting one. And this is a big change that's kind of happened in the last 18 months. And with this, you've got, and we will work through when I show you the example about how that comes together. So there are some obviously non-cash charges, and I think we've all been through, I think we all know how to do the lease calculations now. I think we've all had a pretty good crack over it over the last couple of years, and we're in a position now where we know how to do that. But obviously you have your non-cash impact of your depreciation and your finance charges, as your asset depreciates and your interest and finance cost kind of unwinds. But the physical cash payments of rent now go through in finance, and that's noted in AASB 16. So yeah, it's a bit of a change there, and that kind of supersedes what's in the cash flow standard. So something to bear in mind. Getting into non-cash activities now, and I have mentioned a couple of them as we've kind of gone through, but depreciation and amortization. That's probably the main one you'll see, and when you do your cash flow rec note, that's the main one that's there on every one. Basically, that's going to be normally, every company that we deal with has some element of plant and equipment, which is depreciating as a minimum. Share-based payments, I mentioned this previously, and these are interesting. And this is basically, your valuation is calculated, and we've done a session on share-based payments, a few months ago, and you work out what your valuation is based on whichever model you're choosing, Black-Scholes, binomial, etc. And then that's an add back because there's no physical cash changing hands. The only time when this might happen is if you have like some kind of employee share loan, and there is a requirement of whoever has the employee share loan or options for that matter to actually contribute physical cash to the company. So when we've spoken about employee share loans in the past, we've calculated the value of our share option, which is obviously non-cash. But then if the participant has to purchase shares at a set price, then they obviously have to contribute cash. So that will come in as a cash inflow from financing activities. But the initial calculation of the cost of the share-based payment is non-cash and will be added back. Conversion of debt into shares, that's another one. So obviously we're issuing convertible notes, so that would go through, that's probably another example of a financing cash inflow. So if we receive funds from convertible notes, that would come through as financing. And then quite often, in the space that we operate in, the micro cap, small cap, medium cap, these are often converted into equity rather than repaid in cash. So when that happens, that's obviously a non-cash transaction. So the conversion into equity won't impact your cash flow statement. But obviously, it will be a non-cash item, which will be added back. And there may be some kind of, finance charge and such like, which is non-cash. Quite often on these instruments, interest is accrued, and that basically converts into additional shares. So you might find you've got a non-cash finance cost going through your P&L, which you kind of need to add back in your cash flow rec note. So just something to bear in mind there, and that can be quite an intricate matter. So if you do kind of come across that, more than happy to have a chat if required. There we go. That's the next point there, non-cash interest. So I think we've just covered that off. Hire purchase additions are an interesting one. So it's quite, there's two schools of thought on this one, and it's kind of like, you know, is the cash physically hitting our bank account, and then we go out and pay for the asset, or you know, are the bank just handling it totally from their end and we're just collecting the asset and then the hire purchase agreement starts? So it's kind of two schools of thought there. If you do have, if the cash does physically hit your bank account, you should treat it as a cash activity. But if there's no actual transaction of the cash hitting your own bank account and it's handled solely by the bank or the financing company, then you know it would be a non-cash addition. So that's just a common not necessarily a common mistake, but something that people don't always think about when they're doing this, and it's just something to bear in mind. As I mentioned previously, the lease accounting adjustments, which are important, and then obviously bad debt and inventory provisions. So these are non-cash and will be added back as we go. So you know, if you have that provision, it's going through your P&L as an expense. You obviously need to add that back to your non-cash activities when you're doing your rec note. Likewise, if you have inventory write-downs, and then purchase of assets for non-cash consideration. So quite often when you do a business combination, you might issue shares rather than paying cash. So that's just something to bear in mind as well. So I'll go on to the guides to preparing the statement now. So I've got three examples. So I've got the standard cash flow statement. I've got the standard cash flow statement, and then I've got one which shows you the business combination, and then I've got one also which talks about discontinued operations. So the discontinued operations one is that's probably the one you're going to see the least, and it's probably the trickiest one to do. So we'll leave that one till last. The business combination one, I think, you know, the space that most of the people on the call operate, BizComs are quite common. So I think it'll definitely be some value in showing you the intricacies of that calculation and how it kind of comes together. But I'll just start off with the standard cash flow as a base, and then if we've got any questions, we can look at that. Otherwise, we will just progress through. So I've got a step-by-step guide here. So what I might do is I might just come out of the slideshow view, and if when I'm showing the spreadsheets, so I'm just going to bring up is this the standard one? No, that's not the standard one. That's not the standard one either. Here we go. Just hopefully that's big enough for everybody to see. If it's too small, shout out, and I can make it a little bit bigger. But hopefully that's okay. So I guess just when we're going through the cash flow statement, so step one, populate. It's too small. Okay, sorry. Let's go back. Is that better? Hopefully that's okay. Oh. Cool. All right. That's great. So we'll start off. Step one, populate the P&L and balance sheet. All right, excellent. Thanks, guys. So populate the P&L and balance sheet. So quite often when we're doing the cash flow statement, what we like to do when we do it is to kind of simplify the process. Rather than kind of doing a full TB and looking at every single TB account, we almost want to get our statutory P&L and balance sheet ready to go, and then use those kind of account classifications to do our cash flow statement. So this basically should save you quite a bit of time, and that's kind of, I think it's a more efficient way of doing it. So I mean, there are a school of thought that you do every single TB account and compare it year on year and go from there. But I feel like this kind of gets you to a point where it probably does get you 95% of the way there, I suppose. There might be a couple of intricacies, you know, you might find, for example, in your receivables, you've got your R&D grant buried in there, so you have to split it out between customers and grants. But in most cases, you can get 95% of the way there by doing this. And so basically, I like to, when I'm doing a set of financial statements and I've got my kind of financial report together, and we use, I know a lot of people on the call are using financial reporting software, which is great, but the guys are obviously doing it in Word documents, and that's fine too. But once we've kind of got the base of our report done, so we're happy with our trial balance, we've locked in the numbers, we're happy with the classification of our P&L, be it revenue, expenses, finance costs, etc. We're happy with the classifications of our balance sheet. Potentially, it's already been audited if you do require an audit. We're kind of in a position where we're happy with our numbers, and that's probably the best time to do the cash flow statement. What I find is it's one of those things that you only really want to do once, because if you basically have late adjustments in your balance sheet and P&L, then you've got to go back and update your cash flow statement, and it can be a bit onerous. So normally I leave the cash flow to the last thing I do when I'm doing them, and that's just kind of how I work, and that's just my advice, I suppose. But once we've got that P&L and balance sheet locked in, the first thing we would do here, and I can provide a copy of this template for anybody who's interested, but if you just let me know, because obviously I won't be putting this up on the website, so you just need to email me directly if you want a copy of it. But basically enter the current year and prior year values based on account numbers. It's how it's presented in the financial report in the balance sheet and P&L. So you can see here we've got current assets, we've got non-current assets, we've got current liabilities, etc. No non-current liabilities for this one, which is good. Equity, and then our P&L, which is split based on how it's classified in the financial report. So that's the first step, and that's obviously pretty straightforward. And the system then automatically calculates your movement, which we then explain on the second half of the page. So I go back to step 2. So the next thing I like to do is really look at the investing and financing transactions that have incurred first, because they're usually the more tricky parts to complete. The operation stuff kind of fixes itself, and you can kind of just go through and organize those. So if I go back to here, so how this is structured is we have our operating activities at the top, and you can see there we've got receipts from customers, we've got payments to suppliers and employees, we've got grants, we've got finance costs, we've got tax, and we've got interest received as well. So then we go over into our investing and financing, which is here. So we've got term deposits, loans, proceeds for issue of options, payment of dividend, lease repayments, and these are just the examples. So like I've gone through before, there might be a few other things that are important, but some of the it might be relevant to you guys, but some of the ones obviously that are kind of useful for you, obviously, to look at our acquisition of PP&E. So if we just look at the PPE line, for example, we can see here we've got a movement of 52. 520 in the year. So this is the current balance, this is the prior balance, this is our movement. We then work out, we go to our fixed asset report and we say, okay, how much PPE have we bought this year? What are our fixed asset additions? And this number should really reconcile predominantly to what you've got in your additions in your fixed asset note in your accounts. Sometimes it won't, obviously, because you might have some assets that you've bought at the end of the year and they're still in AP and you haven't physically paid for them, but it should be comparable. It should be broadly similar as a kind of a start point. So here we've put in our 422. We've then kind of, as we go into our non-cash items, we've got our depreciation here, which is calculated for the year, and then we've got a disposal here, which obviously is non-cash as well, for 50 grand, which we didn't receive any cash for this disposal in this example, so it obviously doesn't factor into our cash flow statement. And then effectively what should happen is this balance should then all be zero. So as a nutshell, you've calculated your movement between current and prior, and then we've basically explained that movement in that account from a cash flow perspective through this part of the working. So that's just kind of and then obviously that should balance to zero. So if that doesn't balance to zero, you've obviously got a problem, and then you need to kind of go back and figure out how you're doing things. So just to kind of clarify from a sign value as well, obviously a negative is a cash outflow in this perspective, and a positive is an inflow. So that's just kind of PPE as an example. If I went through a couple of others for you, probably the other one that's quite interesting is the right of use asset and how that's kind of calculated now. So obviously we've got a depreciation charge on our asset, and then new assets acquired. So we bring a new asset on, and that's all non-cash. We then have our lease liabilities here, which basically brings in our new asset acquired. So that balances down to zero, and I'll go into the non-cash and how we check that in a second. But then we also have our lease payments, which is the physical cash that we've paid for our rent during the financial year of 991 there. So that's basically how it works. So the only thing you should have as a cash flow is a physical amount of rent that you've paid for the year. Everything else should kind of come out in the wash in your non-cash items. So that's something to bear in mind going forward when you're doing this yourself. As I mentioned, going back to kind of some of the other things that we've spoken about in investing and financing from earlier on in the session, we have our loans provided for a rated party. In this case, this is in financing and investing, and then we've got a dividend paid here as well, which is also financing and investing. So I guess just probably if I flick back to the slides, so that's kind of how we kind of justify our cash flows. We then just need to check our non-cash items. So if I look at this, we've kind of discussed what the rationale behind these already. So we've got our depreciation in our in our non-cash items, disposal, new right of use assets, lease interests, and then these ones should basically net out to zero. So because they're non-cash, they shouldn't impact our cash flow statement. So when we kind of complete the movements in here, this should always balance to zero. So if you've got an item in here, a cash flow in here, then you've got a problem. So you just need to kind of fix that up. So the other thing that to bear in mind as well with the cash flow statement is that you might often have some foreign currency transactions, which I'll kind of touch on briefly. The cash flow movement in relation to FX shouldn't be the movement in your FCTR necessarily, but we can kind of discuss that in a little bit. So again, we've got some proceeds of issues from options here, and that's kind of like the basis of the model. So you've basically got to have zeros in all your kind of columns on the right, and then the non-cash items should be zero, and then you're left with your cash flows here, which then feed into the main cash flow statement. And that's basically creates a note disclosure for you in the financial report, which you then basically just copy into either your financial reporting software or your Word document. Some of the financial reporting softwares do have like a cash flow module, but I've never been able to really find a good one. So I've always kept this kind of in a spreadsheet. I think it's clearer and easier to understand, and that's just how I've kind of worked through. One of the next steps I would just want to mention though is GST, and sometimes GST on sales revenue, I haven't got it in here, but we should obviously all remember that we are collecting GST on our sales, and that's normally at 10%, and depending on whether we've got international or non-international kind of transactions, and then we need to basically add 10% of this to our cut receipts to customers, and then also take out 10% here, as we're going to have to pay that back to the ATO, but it does hit our bank account, so we need to factor that into our cash flow statement. I have highlighted it here just because I haven't got it in the calculation, but obviously that's something that you guys need to consider, and it's a lot of it is one of those things that does kind of get forgotten about as well, just because it doesn't really have any impact in the overall scheme of things. So your cash flow from operations, inflow or outflow, is going to be the same whether you've got GST or not. It's still going to be the same number, but you need to kind of gross up your receipts and also gross up your payments. So that's just something to remember and factor into your calculations as you go through. We then just check the clerical accuracy, which I've kind of just mentioned. So that basically then feeds back into our cash flow statement. So these cash flows then kind of come down to this level, and they're all linked, and then it just pulls into your receipts from customers, your payments, receipts from grants, and all the various kind of activities. One of the things I would mention here, and I don't have it in this example, but quite often, you do have some bank accounts in foreign currencies. And when you have bank accounts in foreign currencies, there's often a little bit of translation differences between the movements in exchange rates during the year. And quite often, it shouldn't be a huge number, if you've just got the odd account in euros or US dollars and such like. But there is an impact of the movement in that cash balance from the start of the year to the end of the year, and you can kind of work out. You can do a quick calculation. Well, what was my balance? My opening balance at the start of the year was at this rate, but translated at the current year rate, there's a slight difference of a couple of grand, and quite often you see that as a separate line item just to balance your cash here in the Rex note. Normally it's only a couple of grand, so I'd usually put that in payments to suppliers as a difference, just to kind of so that your cash flow does balance, but you've also taken into consideration that item. So that's something to bear in mind. With the rec note, so this model also creates a rec note for us, and we've got a bit of a difference here. So we've obviously had an issue in the formulas, but I've got another example that I can show you anyway. And I'll fix this up. But effectively, the model pulls from our operating cash flows. So it should basically pick up all of these movements, and then they should go effectively straight into your rec note, which then gets disclosed in the back of the financial report. So, and then obviously our non-cash items. So you can see that the depreciation is being picked up. But the reason why this one isn't balancing is because we haven't included like all of our non-cash items in the rec note, so that's why it's not kind of coming across. So if you basically put these numbers in, so we've got our depreciation in there, but we're missing our disposal of PP&E, and we're missing our lease interest, etc., and a number of other items as well. So that's effectively why. And once you kind of build those in, and it can't necessarily be completely linked in the spreadsheet. You kind of got to just manually link them each year, because the business changes, you have new things that come online, and new kind of matters that you have to kind of deal with. So it's something just to bear in mind there. So yeah, that's basically in a nutshell how our calculation works. What I'm going to do is I'm just going to flick to the business combination one next. I'll make this bigger as well. So obviously it follows all the same process as what I've been talking about previously. The key difference is the business combination component of it. And these business combinations are a little bit different in how we do it. And one thing I would note here is that when you're doing your cash flow statement, you look at each business combination, and these numbers here are effectively the values that we've acquired when we've done our business combination. So how when you do a business combination and you've acquired a certain amount of net assets, be it receivables, debtors, inventory, etc., and then you basically say, okay, these are my assets now, and then you disclose that in your financial report, in your BizCom note, and then the difference between what you've paid in physical cash and what you've acquired is your goodwill number. So effectively, these numbers should match up to your business combination note completely. So there shouldn't be any differences there. And yeah, we basically go through that process of adding in each one, which matches up to our business combination note. And then what you'll find is when you get to the bottom of this, further down here, these numbers here in these two cells, so column U and column V, they should be effectively the amounts of physical cash that you've paid for the business. So something to bear in mind there. And then this should basically tie up to your business combination note for your consideration paid in cash. So quite often we see a business combination note and then we look at the cash flow and the numbers are different. So I have to go back to the drawing board and make sure that we've got these numbers kind of figured out. Obviously, if we make payments for stuff in shares, we'd obviously put some impact in these two cells here for issued capital, and then that would modify our kind of the outcome in row 66 there. So it's just something to bear in mind. And one thing to note is obviously when we're doing our cash flow statement and we've got our balance here. Remember, if you kind of look at your operating cash flow, so say you go back to something like accounts receivable, and with the accounts receivable, you say, okay, when I go back here, I've got, I didn't have any accounts receivable because this is a new business, and I've got a movement of 1.6, but only 146k of that actually relates to movement in my balance. So when I look at this, I've obviously got big impacts from stuff that I've purchased through my business combination. But obviously, to get this balance down to balance to zero, you've got to basically put the additional number here, which represents the growth in the additional business. So what that basically shows you is that with this cash flow rec note, which balances, which is great, is these numbers aren't going to align. Your movement in your working capital isn't going to align to the movements in your statement of financial position. And that's something that kind of confuses a lot of people, because you might get the odd shareholder or invest stakeholder in the business, and they look at the cash flow rec note and they say, well, my accounts receivable is 1.64 million and it was zero last year, so why isn't this number 1.64 million? So quite often what we see is, because when we do a business combination in the year, you might find that you actually put a note under this note disclosure and say the reasons why that it's not reconciling, just to kind of put that question to bed, and you don't have to kind of stress about dealing with potential questions from stakeholders on that. So there's something to bear in mind, that it will never kind of work when you do have a biz comb in the year, and that's just something that it's just the nature of the cash flow, but it's easily explainable, obviously. So it's just something there to note. The last one I've got for you guys is on discontinued operations, and we don't see discontinued operations a whole lot, but it does kind of, when you do have a discontinued operation, it does kind of impact the cash flow considerably. And what I'm planning on doing is I probably will do a session on held for sale assets and discontinued operations in the new year, and that will kind of go into this in a bit more detail. But from a cash flow perspective, I think most of you, if you have come across discontinued operations before, it is kind of a big job. And the reason for that is that you have to do a lot of restatements in your financial statements. And with the financial statement restatements, you've got to basically go back into your prior year profit and also your prior year cash flow and almost restate them. So you've got to basically double the work. So it is quite a time-consuming and onerous job. So when we look at the discontinued operations, and I'll make this one bigger so you can all see it. What I'm going to do is I'll skip straight to the end. And how it kind of comes together. So effectively, there's two ways to present the cash flow from discontinued operations. The first one is you can just do your operating cash flow activities, and then you can have the discontinued operation in a separate note, or you can combine them and have the discontinued ops on the main cash flow statement, which I think looks better to have it all in the same place. And just something to bear in mind there when you go through. But with the discontinued operations, it is split out by itself. So you just have one number for discontinued operations activities, and then that basically includes the sum of these three. So from discontinued operations, the sum of our receipts from customers, our cash payments, and our payment of finance costs is 408. Whereas obviously from continued operations, it's the sum of these three, which is your 532. So how do we calculate this discontinued operations number? Well, it's effectively, you've got to do a sub cash flow which feeds into the next cash flow. So if we go to the discontinued ops tab, you can see we're basically doing another cash flow with just the component of the business which is discontinued. And then that effectively feeds into our main cash flow statement here through the linkage in the cell. So, for example, the accounts receivable balance. When we look at the net operating cash flows from discontinued operations, we have 181, 122, which is obviously in there. So it's kind of like you've got to do two cash flows to get to your main cash flow. So that's in essence, it's the same exercise, and then you have this additional kind of disclosure and such like, but it obviously is a lot more time consuming, and you know, you've got to go back and do the prior period as well. So something to bear in mind there when you go through and do that. And then effectively you'd have one column for for operations, one for investing, and then, you know, the financing, and then also yeah, any non-cash as well. So there is a lot to think about on that, and it's not overly common. Like, I would definitely say the BizCom one is pretty standard, and we see that a lot, but this one is obviously more unique, and it does require a bit of extra planning and extra work. So hopefully that's helpful and kind of give you some idea of you know, in terms of preparing cash flow statements. It is kind of one of the more complex areas, and there is some element of judgment, especially when you consolidate between operating and financing. But I think, you know, using the template and using, you know, other people to assist you, you know, your advisors, your auditors, your such like, you know, you can get through it pretty quickly. I think especially as well, the only other real factor in terms of, which I probably haven't explained here or shown in one of the examples, is the foreign currency translation reserve. So if we do have a foreign currency translation reserve, which will be included down here, and this one doesn't have one, obviously that's non-cash. And then effectively what you're supposed to do in your non-cash activities for an FCTR is you're supposed to allocate the movement in the FCTR across all your working capital balances, so your debtors, your inventory, your fixed assets, etc. But obviously that could be quite an onerous calculation. So if you don't have a material FCTR, I would tend to put it to trade payables as a kind of example. Or you could just expense that and put it through as an admin cost. But either way, it's going to go through the operating cash flows. If it is material, you do need to probably think a little bit more about it and think about what's really generating my FCTR, and then it should probably go predominantly to that balance. So say, for example, you're a mining company and you've got, you know, E&E expenditure in a, you know, foreign jurisdiction, and that's driving the majority of your FCTR. When you come to do the cash flow, you shouldn't put it to trade payables, you should put it to E&E. So a couple of things there just to kind of bear in mind when you're looking at FX in your cash flow. Firstly, as I mentioned previously, the movements in the physical bank accounts, and secondly, the FCTR as well. So hopefully that's helpful. I think that's pretty much everything that I wanted to cover today. I did say it would be a little bit of a shorter session. I do really appreciate the support for these webinars, and you definitely will be continuing them on to 2022. I don't know if we've got any questions before we wrap up. I'll just give it a minute or two to see if anything comes through. But yeah, if there are any topics that anybody wants to kind of consider, you know, over the next kind of 6 months or etc., you know, please feel free to email me and we can work through, you know, potentially doing a session, either kind of as a group or one-on-one type thing. As I mentioned before, the historical videos are up on the internet now. And you know, do really appreciate your support in doing these. We do have a couple of things. Yeah, so we will get we will send through the handouts and the slides today. So no stress on that. Yeah, so yeah, we will kind of get that through to you guys. So hopefully that's everything, and I hope you all have a wonderful Christmas. And we'll send the Excel spreadsheet as well. So yeah, I'll coordinate that with our team, and yeah, it should be in your inbox either later today or tomorrow. All right, everyone. Well, I'm going to close it now, and as I said, have a Merry Christmas and a great break. And yeah, hopefully we'll reconnect in the new year. And yeah, have a great day. Take care.